Okay, we are still at the tail end of Note 8. My computer did it again. The wind blew, the paper shuffled, and the recorder shut off. So this will be part 2 of Note 8. And we were talking about redeemable, callable preferred shares. And I was in the middle of saying that very often, if you buy a redeemable or callable share of stock, it is stated right in the stock agreement the price at which the company can buy back the shares and can call the shares and decide that they have to be handed back into them. So you run the risk that if these shares go up dramatically in value on the open markets, you're not going to share in that value, because at some point when the value in the open market of the shares have gone up above what the company can redeem them at, they're going to call your shares and say, well, you agree, even though the stock is worth $300 a share in the open market, you signed on that they could be redeemable at $150 a share. We're now buying back your stock at $150 a share, and of course then they can turn right around and sell those shares again at the market price of $300. There are different benefits that they give to redeemable and callable preferred shares that make them enticing to people at times, so they do exist and people do buy them. But they can be dangerous because they can be bought back from you sometimes in a situation where it's disadvantagedly, where it's financially disadvantaged to you to have them bought back. Before we go on to Note 9 and to the management and running of corporations, one of the things that they talk about in this chapter, and that you really need to know, is something called the business judgment rule. Directors, officers, management are obligated to act for the benefit of the corporation for whom they are employed. And that doesn't matter if they are shareholders as well as officers or directors. They owe an obligation. It's not quite a fiduciary obligation, but they owe an obligation to carry on and to do what is in the best interest of the corporation for all of the shareholders so that everyone can make money. Now, it's a very difficult thing. Economies go up and down, business profits go up and down, business conditions go up and down. Nobody predicted that the entire United States economy would shut down for 3 months because of a pandemic in this day and age, but yet it happened. I am sure that across the country, people are revising desperately and dramatically their business plans to cover for what they thought was going to happen, and then something dramatically different happened in reality. The business judgment rule basically says that directors, officers, management cannot be held 100% liable or responsible for what happens in the greater markets, that there are forces at play here that even the best officer, the best manager, the best director could not anticipate, would not have control over, would not be able to direct or get in on to make sure their company continued to make money and prosper, did not lose money. So to protect these folks from constant shareholder lawsuits that they didn't do the right thing, they could have invested money here and they didn't, and we lost all this money, or they invested in this and it turned sour and we lost all, or they tried out this new product that ended up injuring people and now the company is getting sued and losing money. To protect the officers, now remember, the shareholders are protected from all of this because the most they can lose is the value of their shares. Their individual assets are not at risk. But directors, officers, and management, if they don't have insurance policies, their assets could be at risk by disgruntled shareholders suing, saying, you did not do your job, you didn't make money for us, and now we're going to get you. So, the business judgment rule says that you cannot sue the directors or officers or the management so long as they can show several things. Number one, they acted upon reasonable business information. So they were looking at the reality of what was going on, they were looking at the trends, they were looking at the economic forecast, and they were making business decisions based upon that reality. And if something dramatic, like a pandemic, comes across, a war breaks out, urban rioting breaks out and the corporate headquarters is burned, the massive big one earthquake hits California and 30 million of its 40 million people slide into the ocean. These are all things which the directors, the officers, the management have no control over, and are very difficult for them to even have forecasted. So you cannot sue them for those types of things. And again, the courts will look at, did they act upon reasonable business information based on what was happening at the time. All right. If they can show there was a rational business basis for their action, we bought this because we need gold in processing our microchips, and the price of gold had gone way down after being way up, so we bought a whole bunch of gold, and then the price of gold went even further down. You probably could not sue the directors or officers for that type of decision, because if gold had been so high it was hampering their business. They need gold in their manufacturing process. Gold drops dramatically. They take the risk of, if we do nothing, it goes back up again. If we buy now, we're buying at a good price. We can make our product at that price. We do run the small risk that it could keep going down, but we're going to jump in. We're going to buy it here because this will work for the business. And then gold continues to go down dramatically, and they could have bought it at way less and made tons of money for the business. Again, you probably cannot sue them for that type of decision as long as there was a reasonable, rational basis for them making that decision and taking that action. They can show their actions did not constitute a conflict of interest between their personal interests and the best interests of the corporation. All right. So there are three things basically here: acting upon reasonable information, taking reasonable business activities, and not doing anything that is a conflict of interest between your personal wealth and the wealth of the shareholders. If you can show that those three things were not present in your actions, then the courts will say that you are operating under the business judgment rule, that you are doing what officers and directors are supposed to do. The shareholders can't hold you 100% liable or responsible for the vagaries of the market. You are not insurers. You are people trying to do what you can, the best you can, with the best information you have available. All right, that ends Note 8. We will be moving on to Note 9 from here.